It was not really the red wave that I think a lot of people were kind of projecting. The market were kind of running positive over the last couple of days on this idea that we might be getting this split Congress, therefore a little bit more kind of fiscal restraint. And we might still be getting that, and market has kind of been running on that. Typically kind of in the year after a midterm election, we have markets up on average 14% over the last kind of 10 episodes of that. We do have a little bit more of a negative outlook, seeing the S&P 500 at 3,700 by mid of next year, so it's a bit more of a flat to slightly down market. So a little bit more of a negative outlook, with markets more being driven by what we're seeing from the Fed and the economy.
But if you do end up in a situation where you've got split Congress, you've got a red House, you've got potentially a blue Senate, or even a red-leaning Senate, what that does mean is you're going to get potentially a couple of years of complete fiscal deadlock. What does that do to the outlook?
I think in many ways you could say with kind of a Democrat-controlled Congress, in many ways we would see more of kind of a fiscal impulse, which normally you would say would be good for stock markets because it would be kind of supporting growth. Now in this very, very weird state of the world where inflation has become a bit more, I'd say, unanchored, in my view at least, and it means that the Fed is doing everything it can to control economic growth and actually slow growth. So the weird thing is that fiscal support in many ways, we just see the Fed might even needing to hike further to get the slowdown in the economy, the labor market, and thereby wages and inflation that they'd be looking for. So in some weird way, I'm not even sure that that's what the market is kind of would be cheering for.
Well, it certainly feels like the ball is in the Fed's court at this point. We had former Boston Fed President Rosengren on the show yesterday. He's obviously here at the UBS conference, and he said he thinks the terminal rate could end up closer to 5.5 percentage points, very high compared to market expectations, which is about 5%. What do you think the Fed tightening is doing to investors' desire to get involved in this market?
So it's a very interesting thing, and I think Rosengren had many insightful things to say here at the conference yesterday. And I think what he's essentially trying to tell us is that core inflation is likely to be a bit more sticky. He actually believes that the level at which the unemployment rate will start to see decelerating wages might be higher than the 4% projected, meaning that the unemployment rate needs to slow. We need to see quite negative payrolls in order to get that slowdown in core inflation. And with the Fed on a very kind of determined path at this point in time, like we heard Powell yesterday, they're just likely to continue to bring interest rates continuously higher and thereby slow the economy. So I'd actually agree with him that I think the risk is for the Fed to take the terminal rate a bit above 5% because they won't be seeing those kind of incremental improvements that they'd like to see in order for them to pause at around the 5% currently priced.
One other thing